Today, I quickly want to talk about the topic of consumer confidence as it relates to stock market returns. A lot of times I'll talk to investors that are very pessimistic about the world, they're very pessimistic about the future, and they think this way to protect themselves to pull their money from the stock market. When I'm having those conversations, I like to have this chart or something similar to point out that generally when consumers on the whole are more pessimistic, the stock market tends to do well in the 12 months following. When consumers are really optimistic and thinks the world's a great place to be, stock market tends to underperform in the periods following that. So the consumer sentiment index is essentially just going out and they survey people and find out, do you think the world's doing well and is it going to be better, or is it doing poorly and going to get worse? The more optimistic they are, the higher this figure. The more pessimistic they are, the lower this figure. And what we see is that when consumers are at their most pessimistic, the stock market tends to have above average long-term returns over the next 12 months. So here in 2008, 2011, 22, 2003, 1990, and 1980, at these lows in consumer confidence, over the next 12 months, the stock market rallied. And as the stock market rallies, consumers get more confident as they see the stock market go up, they see their wealth increase, and they're feeling better about the world. And that's when they want to get back into the stock market. Unfortunately, the stock market at that point, once they're already confident, the stock market's already at new all-time highs. And so over the next 12 months, it tends to underperform. So at these points and these peaks in consumer confidence, you see that the next 12 months tend to be substandard returns or below average returns. I point this out just because as investors, we have to ignore our emotions. We have to invest based according to a plan. Because at some point in time, the market is going to feel really bad, really scary, and the world is going to seem pretty bleak. And unfortunately, during those times, that's when it's most important to stay the course, stay invested, act consistently on our long-term plans, and not abandon ship. And again, if we do abandon ship, you have to ask yourself, when are you going to get back in? It's not going to be when things have already gotten worse. The only time it's going to feel like you should be getting back in is when the market's already climbed higher, consumer sentiment is already higher, your personal outlook on the world has become more optimistic, and in that scenario, the next 12 months of stock returns are probably not going to be where they were in the 12 months prior. So again, I bring this to your attention now just so that you can be thinking about it and have it in your back pocket for times when you are feeling less optimistic about the markets. So again, if you have a question about this or anything else, just let us know, and we'll be happy to talk about it. Thanks. Have a great day.